Hi everyone, and thank you all for joining this evening, or wherever you are in the world, whatever time it might be. To introduce myself, my name is Johnny Conran and I'm managing partner at Joseph Mews, and it's my pleasure to kick things off this evening. Before I introduce you to our other speakers and get things underway, a couple of things to mention. Firstly, you'll see on the right-hand side, and I'm sure by this time we've all done this a few times now, but there is a chat box for questions on the right. So if you do have any questions and you'd like to ask throughout the duration of the webinar, then please type them in there, and on the end of the call we'll get answering them. So yeah, please feel free to ask anything you want to ask. Secondly, it's really exciting that Knight Frank have told us that there's going to be an incentive for everybody on the webinar tonight. So I'm going to explain that at the end of the webinar. But yeah, it's a great little addition, a last-minute addition to the webinar today. So without further ado, as I mentioned, my name's Johnny Conran. I work for Joseph Mews. I'm joined today by Andrew Siegel, who is another managing partner based in the UK. And then we're privileged to have both Liam Smith and Harley Trower from Knight Frank. Liam is going to talk to us a little bit about the market in the UK, where to invest in 2024, what we've seen this year. And then we've got Harley, who's going to be talking to us all things mortgages. So obviously incredibly relevant these days, and there's a lot going on in that market. So it'll be very interesting, I'm sure, for everybody to hear from Harley. So without further ado, I'm going to get going, and I'm going to start with a little bit of an overview about Joseph Mews, because I know, having seen the attendees for tonight, there's a few people that know who we are, but I think there's some new clients that won't know a lot about us and who Joseph Mews are and what we're about. So I'm going to kick off with that, and then, as I say, we're going to walk through the UK buy-to-let market, the mortgage market. We're going to hear from Knight Frank about their latest market report, and then we're actually going to have a brand new city centre development launch, which we're really excited to present to you guys. So if we go to the next slide, please. Joseph Mews have been around for a while in different capacities. So we've worked as the distribution arm for different developers in the UK for a long time. We've got an extensive portfolio. We've got thousands of clients around the world. And we pride ourselves from having joined and been partners with some of the best developers in the UK. And obviously having partners like Knight Frank is incredible for us to be able to go to our client base and offer best products on the market from an investment perspective. So as I say, the company was launched a long time ago. Andy Foote is our chairman, and he started the business. And it was all started off the back of Andy's own experience from investing in property and having a pretty torrid time himself, and realizing that they could do better, that we could do better as a business and offer better customer service, offer a better experience for clients, particularly those that are based overseas, but also in the UK, that need their sort of hand holding through the investment process. So as I say, it's been a extensive history now, and I think if we go to the next slide to put it into numbers shortly, you'll see that we've delivered quite extensively throughout the country. The name is something that people often ask about. Why Joseph Mews? It's not a very property relevant name. Well, to give you the history of that, we mentioned Andy Foote before. Here's our chairman, and he's been in the industry for a long time. He started various businesses, but we'll all agree that his most successful business and the business he's most proud of is what you can see on your screen now, the Brain Tumour Charity. So this, you may recognize, it's actually the largest brain tumor charity on the planet. And Andy started that about 20 years ago now. He started it because his son Joseph was diagnosed with a brain tumor age 3 and very sadly passed away age 9. And so Andy has offices and houses around the world that are named after Joseph. And because this is Andy's swan song, we decided that we wanted to name business after him, and Andy loved the idea. So it gives a legacy both to Andy and to Joseph and keeps his name alive. But hopefully that gives some context, but it's an amazing story, and obviously we're huge advocates of the charity. So if you follow our website and web pages, you're obviously able to donate via that, and everything's much appreciated. So we go to the next slide, please. As I said, to put it into numbers, we've actually marketed, sold and delivered 3,480 units as it stands. That's 34 different developments and just under 600 million GDV worth of property. So it is an extensive track record. You know, this there's a lot of properties being sold overseas, but there's not many companies that can say how much they've delivered in terms of, particularly from an overseas client database, to be able to say that we have that many and such a strong percentage from a repeat purchaser the side of things, with 28% repeat purchases, which is great for a business and testament to the fact that we're able to offer consistently decent products all around the UK, different locations, different price points. The next slide, please. So as I mentioned, the whole premise of Joseph Mews and the reason that we shifted from working with one developer is that we wanted to be able to offer clients a variety of different investment opportunities, not just one location, one standard, one developer. We wanted to be able to offer different developments in different locations, some more focused on yield, some more focused on the capital growth side of things. But one thing that remains consistent is that all of the developers that we want to work with need to have a strong track record, the right funding in place, all of the things that as a consumer, as an investor, you perhaps don't have the time to source yourself. That's the job of Joseph Mews to do that. And obviously today we're privileged to be able to be partners with Knight Frank and talk to you about some developments that we're sharing with them. So this gives you a great idea into what we are as a business and the caliber of people that we work with. Next slide, please. So this is relevant both for overseas investors as well as people in the UK, but when you're buying a property, whether it's for your own use or whether it's for investment, it's pretty stressful, and there's a lot of paperwork, there's the mortgage process, there's lawyers, there's renting the property, there's a lot of moving parts that you've got to consider. And it is time consuming, but that can be made slightly less stressful by being introduced to the right partners. So from a mortgage perspective, from the lawyers, from the management, the rental, Joseph Mews deals with every side of this. So no matter where you are in the world, whether in the UK or you're overseas, we can hold your hand through that process and guide you through every stage. And this is really important because, as I said, it is stressful. And it is good to know that you have somebody that's constantly dealing with you and with each step of the way. Next slide, please. And again, so to come on to a couple of case studies of what we've delivered before. This is a development in Birmingham that we are delivering it as we speak at the moment, but we sold out a while ago now, and it's with a developer called Consortia, who are fantastic. If we go to the next slide, I'm using this as a case study because it gives you an idea of the caliber of developers that we want to work with. And if you see on here, this development, Lockside Wharf, actually won 3 first-place awards at the UK Property Awards, one of which being for the best architecture of a multiple residence in the whole of the UK. And it's actually shortlisted for the best in the whole of Europe as well. So these are the kind of standards that we set ourselves as a business, and the kind of property that we want to offer our clients. It has to be the best, not just your carbon copy property. We really want to deal with the best developers, and that's why the partnership with Knight Frank works perfectly for Joseph Mews. On to the next one, please. So another case study is a development just outside of Oxford. The reason I'm using this as an example, if you look at the top of your screen, it will say Cherwell District Council of North Oxfordshire. Now, this was a partnered development with the UK Council, with the government. And obviously that's testament to us as a business that we were asked to be the distribution arm for this development. It was a fantastic success. It won awards. It was on the television, which was obviously great exposure. But again, the main point to highlight here is the fact that we were asked to be partners for this, to be the distribution arm for such a due diligent development in a great location again. And it's been a fantastic story for our investors, with rental yields above 7% and substantial growth in the 2 years that it's been in existence. Next slide, please. Again, as I mentioned, it won various awards and has had huge exposure, and it's as I say, testament to the development and everything, the design and the location and the price point that we obviously were a part of delivering. Next slide, please. Again, these are some images, and following on, we're obviously going to hear a little bit more about what we do deliver as a business and the kind of target that we aim towards. Liam's going to talk you through that, and Andrew as well. But one thing to point out is that everything that we deliver, every development that we're a part of, is aimed towards the professional market. We don't build student accommodation. We don't build what you would call first-time renters accommodation. We want to have clients that treat the property in the correct manner, that provide longevity, that stand the test of time, and that's the kind of property that we build. So it's always aimed towards that audience, and you'll see that from the developments that we present to you later. If you go through to the next 2 slides. So I think we're going to hand over to Liam shortly, but just quickly, I think hopefully this works and we'll test our technological skills here. But we have a poll question for everybody on now to ask, what's your primary objective for property investment in 2024? And it's always good to know from our audience what your options are and what it is that you're mainly looking for, and so we can address that relative to your desires. So give you a couple of seconds to fill this out before I hand over to Liam. And I think we'll see the results at the end. All right. Can we go on to the next slide, Sanjana? Perfect. So we see that, as expected, I think that the main the primary goal of clients tends to be the capital appreciation and long-term wealth growth. And, that is how we would always promote our properties. And going back to what I just said as the reason why we build to the professional market and that that higher quality that stands the test of time, is that this isn't just a short-term gain. This isn't about a short-term investment. UK buy-to-let property is a mid to long-term investment goal. And that's why the appreciation and the long-term wealth growth is the most important part here. So it's interesting to see that seems to be the main perception of our audience as well. So without further ado, I'm going to pass you over to Liam Smith, who, as I mentioned, is a partner at Knight Frank in Birmingham. And Liam's going to talk you through the UK property market and the forecast for 2024.
Thanks for that, Johnny. As Johnny said, I'm at Knight Frank. I head up our residential investment department in the firm, and I'm just going to give you a general overview of the market, the patterns in the market over the last 5 years, what we've seen over the last 12 months. Some people are perceiving it to be a bit of a softer market, and also what we're expecting over the next 12, 24 months, and then leading us up to 2030. So next slide, please. Okay, so one thing that I'm constantly asked by clients, whether they're in the UK or overseas, is why is the UK so popular for buy-to-let investment or inward investment in the residential market? And the main reason for that is because it's probably the most robust property market in the world. And if you have a look at the graph there, it shows that since prices were recorded back in the 70s by Land Registry, we've been seeing consistent doubling of pricing. It started being quite a short period, every 5 years, every 6 years, started going into sort of like 13 years, 14, 15 years. But we're now seeing it taking slightly longer. So property prices are predicted to sort of double every sort of 20, 25 years now. But you're going to see constant capital appreciation, which, going on the last poll and the last slide, I understand is very important to people on this particular presentation. One of the other things that's really, really popular and what makes the UK property market so appealing is that it is one of the only countries or one of the only regions globally where you can actually use a bank's money to invest in an asset. It's the only investment class that I'm aware of that you can actually borrow to invest. Which makes it very, very appealing, being able to leverage against that asset like bricks and mortar, something that's tangible and not volatile, that's going to lose money overnight, is very, very appealing for those investors. So it's great for long-term investment, but it also gives you that stable asset class. So if you are looking at diversifying against stocks and shares, where they may be a little bit more sort of like heavy return led, but a little bit more volatile, then property in the UK is definitely the place for you. Can you just go to the next slide? So what have we seen in the last 5 years? So we've seen quite a lot of growth in terms of property prices and capital appreciation over the whole of the UK. And what underpins the market in the UK is its supply and demand and the imbalance of that. There is a consistent shortage of properties being built. So if we go to the UK's 2019 government housing target was to build 300,000 new homes every single year to meet the demand. That figure now stands at 340,000, and that's due to a consistent shortfall in delivery. Back in 2022, there was only 233 new homes built, which means there was a shortfall of 107 new homes, which is obviously worsening that housing crisis. Now, as a result of that, the average prices in the UK over the last 5 years have increased by roughly 26%, or 25.9%, if you want to be completely accurate. Now, some regions were a little bit lower than that, and some regions are outperforming the rest of the UK. And they're the regions that we are focused on, both at Knight Frank and with our partners such as Joseph Mews. But what's also happened is renting has become more affordable than buying for the first time since 2010, which in essence has pushed rental values through the roof. So rental yields are improving year on year, making the buy-to-let investment even more lucrative. Now, just to give you a little bit of a takeaway, Birmingham's rental market this year has seen a 14% increase in average rental asking prices. That's from January to now. That's an incredible increase just in 1 year. So in essence, a housing shortage means that there's significant investment opportunities, certainly in the residential market. We go to the next slide. Okay, so where does that leave us now? So let's touch upon the last 12 months. So since the mini budget last November, we have seen a softening of the market 100%. There are less transactions going through this year than there was last year, and certainly the year before that. And why is that? Well, inflation, cost of living, and also the interest rate hikes from the Bank of England. So as and when the rates were going up and up and up, there was less buyers because they were leaving the market because of affordability issues. Now, what we haven't seen is any drastic price reductions. So we've not seen the market completely crash, where prices have gone down 10, 15, 20%, like the press were reporting at the start of the year that they anticipated huge price decreases. That hasn't happened. The national decrease across the UK is roughly just under 2%, which is not too bad. Now, certain areas they're slightly higher than that, and certain areas they've actually remained stable. And in one particular region, they've increased as well. So that's put us in a position where we have revised our pricing predictions for the next 5 years. So where we were anticipating growth of 2, 3, 4% year on year for the next 4 years, we're being slightly more conservative in a way that we're saying 1 to 2% anticipated growth year on year for the next 5 years. Now that will only really start to come into play when the Bank of England's base rate starts to decrease and there's more and more confidence in the market, therefore more transactions, and prices start to rise again. Now the impact on mortgage rates, obviously we're currently seeing lenders already reducing their rates to be competitive. The Bank of England base rate stopped rising, I think, last month or the month before, so there is definitely confidence back in the market already. And we've already seen an increase in transaction levels just on the last 4 weeks alone in comparison to previous months this year. So past growth, let's take the last 5 years, for example. If you want to go back to the 70s, you can see that chart. There's always a slight softening in the market, which is called a correction, which is what we're probably in now. And then there's another increase or a surge in property prices. So if we take the pandemic, for example, where there was a lockdown, so we had no choice, we couldn't buy property, we couldn't sell property for about 9 months. And as soon as those lockdown measures were lifted, there was a surge in transactions, and ultimately property prices went up by about 9% in about 6 months. If the market has softened now, and we're in about a year of this cycle, and property prices remain stable for the next year, and interest rates start to decline towards the end of next year, so they're becoming more and more affordable, the expectation for the tail end of 2024 going into 25 is when we should see a slight surge in transactions and therefore an uplift in property growth itself. So if you're looking at investing in property, if you're to buy today something that's completed, you're not going to lose money as long as you don't sell it this year. However, what I would probably recommend is buying something off plan, where you can secure something with a lower deposit and secure something that's going to complete middle of next year, end of next year, or even into the following year, where you may be able to benefit from a better mortgage rate. Which brings me nicely on to passing on to Harley, and he can talk to you about the rates and the expectations for the next few years. Thanks.
Thank you very much, Liam. Good morning, good afternoon, and good evening, depending on where you are in the world right now, for everybody that's on the call. Just as an introduction, my name is Harley Trower. I'm one of the sales managers and associate partners at Knight Frank Finance. Knight Frank Finance are a whole of market mortgage and debt advisory broker. We work with both UK residential and international clients. Today, I'm going to be giving you a brief overview of the wider mortgage market, and then more specifically focusing on what the UK buy-to-let market looks like in its current position and how we forecast it to be over the next 12 months. Now, it'll be no surprise to everybody on the call today that mortgage interest rates and mortgages in general have been a very hot topic over the last 12 months. So I imagine that there will be many questions for me, and I welcome them at the end of the call, and I'm very, very happy to follow up after with anything more specific. Next slide, please. So just as a general overview where the mortgage market is at right now on a whole, I think that the main concerns for buyers and prospective clients is the current inflation position in the UK. The latest information that we've received is that inflation currently sits at around 6.7%, which is lower than the forecast from earlier on this year. And the good news is that the Bank of England have estimated that they are towards the end of their tightening cycle. The current Bank of England base rate sits at around 5.25%, and that was held there after 14 consecutive increases on the 9th of September. The next review for the base rate is on the 4th of November, which is next Thursday, and the general consensus is that it will be held at 5.25%. What this ultimately will do is we'll put some encouragement back into the main investment markets and hopefully drive fixed interest rates down a little bit further, with swap rates starting to fall, as we've seen over the last few months. As mentioned, mortgage fixed interest rates are starting to come down, and that's really with confidence coming back into the market, but also because we have to remember banks are commercial financial institutions that have to continue to lend and have to find ways to be, whether it be more creative, more courageous in the market, or a little bit more risk inclined. We've seen an uptick in borrowing nationally over the last 3 to 4 months, which is very, very encouraging and should encourage more transactions globally over the next 12. Another thing to mention really is around private lenders in the market, because typically the way that they act does then encourage the other retail lenders. And we've seen private banks in the last 4 to 6 weeks lower their margins below 1% for all tracker rate products. Just a little bit around the other options for mortgages in the UK right now, with the lenders becoming more creative, more courageous. We're now seeing that over 90% of lenders in the market will offer a 40-year mortgage term. Why is this important? Because with the rising cost of living and of course rising interest rates over the last 12 to 18 months, lenders want to be more creative and want to continue to lend, as mentioned, with the ability now to lend for 40 years and potentially up to age 75, and in even some cases on a holistic style approach, being able to lend up to age 85 with retirement income included. There are many, many more options for both buyers and other parties that are considered in the transaction now, which will of course encourage buyers to continue. Just a highlight on mortgage products and where they are at right now. So as of today, the latest information that's published, we see to be around 16,888 mortgage products available. Why is this important? Because we really consider anything above 13 to 14,500 to be a really active market. if we consider pre-COVID levels, sorry to bring that point up, but pre-COVID levels, we were sat somewhere around 16 to 17,000 active mortgage products in the market. So for the first time in the last 3 years, we're back up at the level of amount of mortgage products in the market available. Just as a reference, post mini budget in September to October last year, we saw mortgage products reduce all the way down to 7,650. What that ultimately meant was with a lack of mortgage products, there was a lack of competition for market share. And with a lack of competition for market share, interest rates kept increasing, and we saw no real relief within the market. In addition to that, just earlier this year in June, we also saw mortgage products reduced down to 13,500. The reason again for that was with rising interest swap rates and lack of confidence within the market, a lot of lenders couldn't find ways to lend and couldn't find ways to price products in order to actually be competitive. We now, in reflection, see ourselves to be in a good position, and it should, moving into next year, should really increase and markets should become more and more competitive as swap rates reduce. Could I have the next slide, please? Oh, I think we have a poll question now. So everybody online, have a read of the question and feel free to answer where you think that or what loan to value you think a buy-to-let investor can secure on a UK property in the market currently. When you're ready, let's see what the answers are. So pretty mixed across 60 and 70%, but the majority are in at 75%. And we'll come on to, I suppose, the answer very shortly. So as mentioned, I now wanted to give just a little bit of a more in-depth overview into the buy-to-let market, because I believe most people on the call today will be prospective buy-to-let investors. Now, with rising interest rates over the last 18 to 24 months, we've seen a constant review with stress rates from the lenders, which will ultimately determine exactly how much you can borrow on a property based upon what the anticipated rent is, or for property owners, what the current rent on the property actually is. Upon the increase in interest rates over the last 12 months, we've seen most lenders increase what their stress rates are to anywhere between 7 and 8.5%. However, over the last 2 to 3 months, we've seen a lot of lenders sit down and review them, and as mentioned, looking to try and stimulate some borrowing and some activity within the market, look to reduce them again. As things stand, the average stress rate is now down to 6.15%, which on a £300,000 purchase will actually allow you to borrow an extra 10% based on the same anticipated rental income, which is massive when we have clients who are always looking to try leverage up to what their maximum potential are. As mentioned earlier in the call with Johnny and Liam, if you are looking to purchase a property off plan and you're looking to position something that may complete later into next year or even potentially the year after, with the forecast that these stress rates will continue to decrease, it's likely that if they come down to say 5.5% or potentially back down to the original 5%, which was a pre-COVID stress rate, that you would actually be able to get potentially a further extra 10% in borrowing, which will only be, of course, more advantageous for you when considering an off-plan purchase. Now, an alternative method in order to try and push the leverage options, ultimately the loan to value, the amount you can borrow against the property's value, is to also consider a method called top slicing. This is ultimately where we would use your disposable income from any alternative source, whether that be employment, self-employment, or background income such as property, in order to top up any rental shortfalls. Ultimately, let's theoretically say that using the rental income, you can borrow 60%, but your ideal position is that you would like to borrow 75%. Then if you have disposable income that can meet the rental shortfall amount from, let's say, employment or self-employment, you would then be able to top slice that in order to get up to that higher amount of leverage. And this is something that's now offered by lenders both in the UK and internationally. So if you're considering a purchase from overseas, we do have options where we can help facilitate that. Now, the main changes for buy-to-let investors over the last 4 or 5 years is that most lenders will now also consider first-time landlords and first-time buyers, and a combination of the two. Ultimately, without any property experience, there are lenders both UK and internationally that will allow you to approach them for borrowing via brokers like ourselves and be a first-time buyer and first-time landlord with no previous experience. In addition to that, some lenders have looked to be more strategic and competitive when lending on buy-to-let investment properties, and have now removed the requirement for any type of minimum income, whereas historically some lenders would look for a minimum income of between £25,000 and £50,000, depending again on the residency position, the amount you want to lend, and your lending position, of course. Further to that, if you do have previous experience or you have current experience renting a property, most lenders have removed that requirement for income in total, and that goes for both UK and non-UK residents. The age that you can actually lend up to, with everybody now living longer, of course, has now increased with you being able to lend up to age 105 across most markets. And that includes being able to actually submit an application at the age of up to 85. So ultimately you could take a new mortgage as a buy-to-let at age 85 over a term of 20 years. Seems crazy to a lot of people probably on the call, but that's purely because the rental income as an asset will be the coverage for what the mortgage payment will be. So there is no concern around what your employed or self-employed income would be, or what your current pension receipts may be. There is also now less property restrictions, something that's very important for people that are considering purchasing on this call. Going back maybe 5 or 10 years ago, a lot of people would be concerned around buying a new build property because they may only be able to raise X amount on there, and would that have resale position or resale issues? Now, the majority of the market will consider lending up to 75% on a new build flat and houses for buy-to-let purposes, and for residential purposes up to 90%, which is standardized across the market. There is also more flexible products with the ability to exit without early repayment charges. This is important because in a market that's moving very quickly with a lot of interest rate adjustments, if you are looking to position something to purchase off plan, whether it be 12 months in advance, or you're looking to buy something that is a little bit sooner, we can help clients isolate and identify the right type of product, whether it be a tracker rate product with no early repayment charges, with the view that we would maybe review that once fixed interest rates come back down into 24 and 25, or whether it's a fixed interest rate. And then just a closing point, I think, for today. The majority of the clients that I do speak with are considering off-plan purchases, but don't want to take the risk of potentially moving forward now and not knowing for certain what a final solution would look like. My reassurance to clients that are considering that on the call is that we do have access to some exclusive solutions where we can secure a mortgage offer up to 12 months in advance. Now, if you are considering a scheme that is being spoken about today and you're within that 12-month period, we could potentially secure you an interest rate that would act purely as a contingency plan, as a scenario that you would know this would be your interest rate at the worst case scenario. And then our commitment to all clients is to review that solution on a bi-monthly basis to ensure that it's still the most suitable and the most cost-effective solution that could be available to you. It's very likely, of course, based on where the forecasts are, that in the next 3 to 6 months there may be a more suitable solution, and we would simply then look to reapply for our client while having the contingency option still held in the background and available to draw down on once in a position to complete. Thank you very much. I would now like to hand over to Andrew Siegel, and I look forward to answering some questions at the end.
Thanks, Harley. Some really good information there. If you've got any questions regarding mortgages, as Harley said, whether it's current or future mortgages, just type your message into the box, maybe put mortgages in there. Harley or one of his team will give you a call and run through options and maybe what you're looking to do, or even if you're planning, good to see things like affordability and get some indicative rates and things. Okay, so let's look where to invest in the UK in 2024. Can I have the next slide, please? I think my slides are running a little bit slow. There we go. Excellent. I guess we've got first-time investors and experienced investors. So out of those locations there, again, just have a tick on what you think holds the most potential for 2024. We've picked a few areas that most people will recognise. So if you could just fill that in, and then we'll have a look and see what that brings. Okay, if we can see if I can see the answers on that one, that'll be great. Lovely. There you go. Okay, fantastic. London 25%, Manchester 4%, Birmingham. Very interesting. Okay. I suppose location obviously is important, and we have clients from all over the world, all over the UK, and they say, I live in Swansea, I want to invest in Swansea, for example, and that could be good. But with the right partner, it's worth looking further afield, because of course we can get higher returns in terms of capital appreciation, higher rental yields, and I'll cover some of those areas, and we'll look at some of the facts and figures as we move on. Let's have a look at the next slide, please. Thank you. As Johnny mentioned earlier, our role is as a property promoter. What does that mean? Well, we work hand in hand with developers. We do all the sales and the marketing, which is the easy bit, but more importantly, we're tied in for the duration. So we get our investors to exchange, to completion and beyond. So we're a one-stop shop. So we help with mortgages, lettings, snagging, furnishing, solicitors, handovers. So developers love us because we're a one-stop shop. So we do all that customer facing and customer care side of the business. Developers can then just get on and build. But more importantly, we're a one-stop shop for our clients. So we do everything in-house, or as we've seen today with approved partners such as Knight Frank. As a promoter, we do a lot of research, and a lot of that is shared on our website. And again, with Google today, it's very easy to get fairly informed sort of fairly quickly. If we look at historic housing prices, as we saw, on average, property prices will double every 13 years or so. So you could argue, doesn't matter where you invest, let's just have something, let's just sit on it, and away we go. And sit tight, enjoy the capital appreciation, and enjoy the rental yields. However, with a little bit of research and a bit of work and a good partner, you can outperform the market. You can make your investments work harder for you in terms of capital appreciation and rental yields. And as I say, it's good to do a little bit or a lot of research, because it can really make a difference, particularly when you're looking at higher costs, stamp duty, mortgage rates, etc. As I say, we're very choosy in terms of who we work with. We don't work with just any developer that comes along. We do all the due diligence. We work with partners that sometimes sit between us and the developer, like Knight Frank. We look at the areas that they're building in, and we look to what we think will give our investors the best return. And we look at the fundamentals such as we've got below. If it passes our test, if we're promoting it and we're getting involved and putting our money into it as well, then it's going to work for us. It's going to work for our investor clients. So I've got 6 areas here to look at. First one, I guess, is connectivity. Where is it located in the country? How accessible is it to other parts of the country? So when we look at the rental market, you have, obviously, if we're investing in a city centre, you've got that city centre market, but you have what I call that sort of further afield rental market. For example, in Birmingham, it's the #1 location for people leaving London and relocating elsewhere. So the #1 choice for people moving out of London, they're moving to Birmingham for many reasons. One of the reasons is today there's already 171 trains. We'll come on to HS2 later. There's 171 trains that go between Birmingham and London today. HS2 will cut that down to 49 minutes from about 128 minutes at the moment. So that kind of connectivity and infrastructure is important. If we look in London, the Elizabeth line, massive infrastructure project running from Reading across to Canary Wharf, east to west, west to east, has had a huge impact on areas where those stations are. If you look at Slough, for example, you've got, if you're building there, if you're buying there, you've got that local rental market, and then you've got that London commuter belt market. You're 10 minutes on the Elizabeth line into Paddington, and prices in Paddington are double the price. So from an investor point of view, it works really well. And some of you may know that Elizabeth line will take you from Reading all the way across to Canary Wharf without getting off the train at Paddington, getting on 1 or 2 tubes. So 18 billion pounds, I think that project was. So that really has an impact on pricing of housing, of apartments, of anything really in and around that area. So we always want to look at current connectivity and sort of future connectivity as well. Places like Birmingham are well connected anyway, but with HS2 sort of really gives the icing on the cake. In terms of future development, what else is planned, be it other residential projects, commercial projects, public realm infrastructure? So we want to have a look and see what's going on in the area in the city centre. And of course, a lot of the land in the city centre is built upon. So if you can't be right in the heart of the city, what's going on in the suburbs and the outskirts? And is that a good place to invest? I think one thing we're seeing, particularly in certain areas we're developing, is these BTR schemes, build to rent schemes. So this is predominantly banks, institution, pension funds. John Lewis and even Marks and Spencers are getting into this field. So what's a build to rent scheme? Well, it's where one of these institutions build a whole block. They don't sell those blocks. They're just going out onto the rental market. These institutions aren't stupid. They're going into areas where they know build to rent will give them the yields that they need and that their clients need. So again, if you follow these pension funds, these institutions, John Lewis, of course, have got property, Marks and Spencers have got property, so they're looking at their city centre locations to get into build to rent, and these are coming thick and fast in certain areas because they know, as we saw earlier, massive shortage of housing in the UK. They know it's as safe as houses. They know they're going to get the rental yields for their investors and for their clients as well. One question therefore we get asked, if all the big boys are coming in, will the market be overcrowded with these institutions coming in? No. We've seen, we looked at some of the figures before, and if you look, we should be building on average 230,000 homes a year. We've barely been scraping 200,000 homes a year, not for 1 year or 2 years, it's for decades and decades and decades. So again, it's really important to have a look at those sort of supply and demand dynamics. It would take, if we were building the 320,000 home we need now, it would take 50 years to redress that supply and demand dynamic. So again, what's happening in a city or an area is really important. Then you've got things like the regeneration and local economic factors. Again, easy to find out what's going on, and companies like us share all that data with you, and certainly companies like Knight Frank, who are one of the world's largest real estate companies, they do a lot of research which we leverage on as well. One of the areas we're building in has the largest city centre regeneration program, I think in Europe, certainly in the UK. So huge amount of investment going on, massive change. So who doesn't think this isn't going to make a difference to what's happening in the property market when you've already got supply and demand issues? Again, let's take a look at institutions and businesses in the areas we're building in. HSBC have left London. They've left Canary Wharf. Deutsche Bank have moved into this particular area. You've already got Goldman Sachs, PwC. And again, these aren't satellite offices. These are UK or European headquarters moving out of London for various reasons, of course, including cost savings on wages and the like. So it's all about saving money and going to areas where there's people, staff, cheap housing, etc. So of course, we look at jobs and market trends, what's in the areas, what companies are moving in, what's the market doing, where are we with population. So there's a lot of factors to take into account when we're looking at particular areas to build and develop in. And then let's have a look. Again, we've touched upon it already, supply and demand. That is really, really crucial. We're going more down the sort of European route, where 80% rent and 20% buy, and it's kind of the other way around for us, but that's changing dramatically. In the UK, for every rental property that goes on the market, there's 25 people looking at that property and wanting that property. As we heard earlier, in certain areas, we're seeing 50% less property on the market for rent than there was 2 years ago. And I think Liam said in Birmingham, rents went up 14% last year. I'm old. I've never known a better time to be a buy-to-let landlord from that supply and demand dynamic. Yes, costs have gone up, but so rents go up. We're seeing as well what I call, or what used to be on the sales side of things, gazumping. So tenants are offering more than the asking price. They're paying 6 months or 12 months up front for those longer term lets. So again, good timing. Our chairman has had 15 apartments over a 25-year period, a mix of 1 beds and 2 beds in an area that we're building in, which we'll talk about later. The worst void period across any of those apartments is 2 weeks. That's over 25 years. So that's COVID, Brexit, Trump, Ukraine. You know, look at everything that's going on in trusts. Look at everything that's going on in the world at the moment. Again, it's supply and demand that's driving that, because we need food, we need water, we need somewhere to live. We don't move out of our houses because of COVID or because of Brexit. It just doesn't happen. So more people are in rented accommodation, not only due to economics, which of course is a big factor, but it's lifestyle choice as well. A lot of the youngsters like that flexibility and don't want, like us oldies, a sort of 25-year or longer, as we saw earlier, mortgage around your head. And again, by 2025, the amount of over 60-year-olds that are in rented accommodation will be treble the number than it is today. So we are going very much to a rental market. Again, that's why the institutions are coming into this market. Okay, next slide, please. Mine's a bit slow. There we go. Fantastic. So we did a little poll earlier. We looked at different areas. I mentioned earlier, you know, if you bought long enough ago, you hold on to it. Happy days. My dad bought his first house for £1,950, and he's done all right on that. He bought a lot more stuff, but he's done all right in terms of capital appreciation. So with a bit of research and a bit of work, you know, we don't just want to stick a pin in the map. We want to look at areas where we've got the things we looked at earlier, really. Affordable pricing, good rental yields, affordable infrastructure, tourism, improving economy, public realm. So again, lots of research to do, which we've done, lots of information that you can look at. And again, there's some great places on there. Nottingham, we've developed in the past in Liverpool, we've developed in Manchester, we are and have developed in Birmingham or Derby. So property investment, we want to take the emotion out of it. It's, you know, it's about maths. So we want a low price point, we want a good average rental yield, as we saw on your poll earlier, and we want good capital appreciation. And again, those are average rental yields. With the locations we build in, with the developers we work with, we always get more than the average rental yield. And in certain locations, we work with specialist corporate letting partners. So it's kind of short-term corporate lets. So whilst the management costs, etc., are higher, the returns are. Who cares about a gross? You could be renting it for £1 million a month. It's costing you £1,001,001. It doesn't work. So we need to look very much at, yeah, gross rental yields, brilliant, but let's have a look at what the nets are. Let's have a look at the real figures. I read the other day, I know we saw London was quite low on the people's charts in terms of where to invest. 70% of investors living in London are investing further north for higher capital appreciation, lower price points and better rental yields. Next slide, please. Okay, so I think this sort of sums it up. What we want to do as investors, we want the cheapest house price with the highest yield. So there's always a compromise because we can go off the beaten track. Aberdeen, relying on the oil industry, prices are cheap, but you're not getting your rental income, you're not getting your capital appreciation. So it's about balance, really, and looking at the slide we saw before with your Manchesters, your Birmingham, your Derby, is getting that low price point, looking at somewhere where we can see that we're going to get the capital appreciation and good rental yields as well. Okay, next slide, please. Okay, so I'm going to talk about a couple of areas that were featured on the slide. Next slide, please. First one is Derby. Derby is the most centrally located city in the UK. Fabulous road and rail networks and links already in existence. Next slide, please. So Derby is the 6th most productive city in the UK. We've got a nice low average property price, a nice high average rental yield, and again with your Knight Franks, your JLLs, predicting good price growth over the coming years, and again good rental increase over the coming years as well. Next slide, please. Because as we saw from one of the earlier slides, as investors we want to have our cake and eat it. So going back to the sort of fundamentals that we looked at earlier, you've got great employment in the city. Bombardier are building trains. Rolls-Royce is the aero engine division. Toyota, they're making cars, it's manufacturing there. So you've got a nice business sector there, and you've got affiliated businesses, and you've got other sectors, IT, textiles, retail. So again, it's got fantastic inward investment. You've got 3.5 billion being invested into the city. That's creating new jobs. You've got young professionals who want to live and work in the area. Next slide, please. The University of Derby has highest graduate sales pay in the UK, and they retain sort of 46% of their students. So those students are going on to live and work. And as I think Johnny mentioned earlier, we don't really cater for the student market. It's that young city centre sort of professional market. So those students are staying there. So that's helping feed the future job market, etc. I mentioned it's a very well connected city, 37 minutes from Birmingham, 86 minutes to London, 29 minutes to Nottingham. Plus, of course, you've got all the road links. You've got as well that local rental market. Obviously, if you're in Derby, you're renting in Derby, but it's affordable to commute to other areas. So again, we're starting from a low price point. So you're opening up the catchment area with that low price point. And interestingly, the average commute time in the UK is 59 minutes. So again, people are used to, on average, commuting an hour each way every day. So again, you've got the local market and you've got that further afield sort of local commuter market as well. Next slide, please. Derby is a great city, culturally dates back to 600 AD. You've got theatres, museum, Derby County Football Club, you've got the arenas, you've got the concert halls as well. and I think a judge of any city these days is probably the shopping mall. You've got a large one here, 200 plus shops with all the brands you might expect, food courts, multiplex, cinema, bowling, play centre. It's actually, to put it into sort of perspective, it's the 15th largest shopping mall in the UK. So that probably gives a good indication on the size of the area and the catchment area as well. I'm going to hand you back to Liam at Knight Frank, who's going to run through a couple of slides on a development that we have exclusively with them, and then he's going to hand back to me and we're going to talk about another area as well. Thank you.
Thanks, Andrew. Okay, so Derwent Point is a development being built by a company called AG Group in the centre of Derby. Price point is very, very attractive, with one-bedroom apartments starting from 162,950. So with all of our sort of off-plan projects with Joseph Mews, we take 20% deposits, and then there's no payments until the completion of the project. So in this instance, this project is due for completion towards the tail end of next year. So as Harley's mentioned, there may be some favourable rates in terms of the mortgage market towards the tail end of next year. This gives people an opportunity to reserve today, invest with 20%, sit back and relax, and then obviously hopefully benefit from better rates towards the end of next year. What I quite like about Derwent Point, a few things. The developer have got a really good track record, and they also own their own construction company, which is quite rare and unique for a UK developer. In essence, it means that the quality of their developments, from if it's in Derby or if it's in Birmingham, it's always going to be the same, and they can always maintain those standards. The second reason is the size of the development. There's only 33 apartments in this building. So it's not a development where you've got a couple of hundred apartments where half of them have been sold overseas and you're in competition with another 100 apartments to rent. There are only 20 apartments actually earmarked for sale to investors in this building, and then Knight Frank are going to take this to the local market closer to completion and sell the other 13 apartments to local buyers, which makes it quite a unique investment opportunity. Derby, like all other cities in the UK, does have a huge shortfall of new builds being built. Apartments more so. There's only about 2,000 apartments in the whole of Derby, which is crazy. But it does mean that you're buying in a development where you're going to have very, very low void periods because there's no other rental competition on your doorstep. If we can just move to the next slide. So as you can see, the apartments are designed for that young professional market, which we've discussed. That's the demographic of tenant that we're obviously targeting in most of our cities. On Andrew's slides, you can see some pretty big employers in the area. Most notably is Rolls-Royce. So there are thousands and thousands of well-paid young engineers that study in universities locally, whether it be Derby or Coventry, that move to Derby to work for the likes of Rolls-Royce and Toyota. And these apartments are designed with them in mind. So they've got nice modern finishes, very unique sort of kitchen styles and bathrooms, and they are very, very close to all networks in terms of those transport links to the external parts of Derby, which is where these large sort of industrial parks are located. Just go to the next slide. I'm not sure if it's moved, but I can't see it. Okay, there we go. Right, so there's a map of Derby. The red icon shows where Derwent Point is located. So the city centre in Derby is condensed to within a ring road. Within the city centre, you have the shopping mall that Andrew referred to, called the Derbyan, where you've got a large array of retail, commercial and food and beverage. You also have a lot of office units in that particular area. As you can see, Derwent Point is located right on the cusp of the city centre. So it's within walking distance to all of those facilities. It's adjacent to the river. the River Derwent, hence why the name of Derwent Point, the development. And it's also within sort of walking distance to Derby sort of Enterprise Park, where you do have further employment. Rolls-Royce, Toyota, Bombardier, those engineering companies, they're a little bit further outside of the city centre, but this area does benefit from excellent transport links to those campuses. This is also very close to the university, so it may appeal to people working at the university, so lecturers and so on and so on. So that's Derwent Point. If you are interested in receiving any more information about the development themselves, or if you want to have a look at the units, or talk to either Andrew or Johnny about Derby a bit more in terms of the investment, put a request on the chat and one of their team can get in touch with you after the seminar in the next few days, and they can talk to you about Derby and Derwent Point. I'll let Sieg now introduce the Birmingham market, and then I'll be back to tell you about a new exclusive development which we're launching tonight. Thank you.
Thank you, Liam. Yeah, so a really nice development there. We can have Q&As and we can explain how we work with Knight Frank and what we do there, but let's, conscious of the time, let's move on and talk Birmingham. Next slide, please. Again, I'm sure we all know where Birmingham is, super centrally located city, very well connected. Again, has all the fundamentals we're looking for: low price point, good average rental yield, good price growth predictions, both in terms of capital appreciation and rental yields. As I say, with our developments, we always deliver more than the national average. And again, with well-managed corporate short-term lets, you can smash those figures because, you know, let's not get emotional. We just want to make the most money out of this. So again, we need to look at it. We have cash flow summaries and all sorts of things that we can share with you on our developments that you know, you can really drill down, particularly with higher costs and stamp duty, and have a look at what your net returns are. Next slide, please. So I want to talk for a minute or five about Birmingham itself. It's the second biggest city in the UK, and it's number 2 behind London in terms of everything, in terms of numbers. It's got the strongest economy. It's got the strongest business turnover, new businesses outside of London. It's got the largest population. We've got a very young market. It says there 60% of the rental market are under age of 35. So that gives you long-term tenants. We always used to say a year or two. They're staying sort of 4 or 5 years now. So you've got long-term tenants in place, which is great if we're going for the long-term tenant market. Good capital appreciation, as you can see, good rental yields. We're starting from a nice low price point, so we can see capital appreciation. The property I mentioned in earlier on that my father bought for £1,950 was in Bristol. Now, if we compare like with like at the moment, Birmingham's the second biggest city, twice the population of Bristol. Bristol property prices are double that of Birmingham, comparing like for like, development for developer and nice area for nice area. So again, Bristol's a lovely place to live, but it's had kind of all that gentrification and regeneration, whereas Birmingham has got that to come in spades. And I'll sort of touch upon that because it's really important to understand what's happening in Birmingham. It'll have a big impact on capital appreciation and rental yields. So there's a lot happening, and of course HS2 as well, which I'll cover in a second, will be very much the icing on the cake. Next slide, please. Next slide. So, massive regeneration. You've got areas like Arena Central, Paradise Circus. So you've got 18-19 new office blocks, newly completed or just being complete. So massive office blocks, and that's just one area. HSBC had moved there a couple of years ago. Half the business has left London. They've left Canary Wharf. Why? They're saving on average £18,000 per employee per year on salary and the cost of the building and running their business there. They're talking about shutting the other half of the business down and moving that as well out of Canary Wharf. So that's just Arena Central, Paradise Circus, just one area. You've got Brindley Place, you've got 12,000 people working there. That's a mixed-use scheme. Deutsche Bank are based there and have been for many number of years, actually. You've got Snow Hill Wharf, which is the largest speculative commercial development outside of London. The last tower, BT took that, and that's 4,000 people there. So again, and all of these areas, a little bit like we saw Derby with the Ring Road, Birmingham is similar. We've built, probably out of the 34 developments we've built and been promoting, half of those are probably in Birmingham. They're all walkable and they're all close. Everything I'm talking about is close to the new development that we're going to mention later on. Birmingham holds the second most pop concerts in the world. You've got more Michelin star restaurants outside London than anywhere else in the world. You've got the largest library in Europe. You've got the largest cultural space in Europe. You've got 4 football teams, massive industry, whether it's financial, tech, retail, clothing, manufacturing. It's fantastic. And on the retail side of things, you've got the Bullring, which is the largest shopping centre, or one of the largest shopping centres in the UK. You've got new trams, which are up and running and being extended out to where the HS2 terminal is coming. So it's phenomenal. There's nowhere better in terms of regeneration. It's a city that keeps on giving. Next slide, please. High-speed train, HS2, fairly contentious, but it's not going on to Manchester now, but we've got it from London to Birmingham. It's going to be the most environmentally trained station in Europe. It's under construction now. You can see it coming on at a pace in Birmingham. And again, it's right. It's not like maybe Hong Kong where you have to get a tram and train in. The train comes right into the heart of the city. So that's going to have a huge impact because it'll be late. It'll be over budget. But it's going to be 49 minutes to London, so it will happen. So now's the time to invest because you're getting in early. And that is and will create 10,000 jobs in around that southern part of the city. Already, we've got Birmingham New Street Station, which is one of the busiest stations in the UK. So, you know, it's not like we haven't got trains. Before Birmingham New Street was developed, if we had a poll, I'd argue it's probably one of the worst train stations in Europe. Now, in 2015, they spent 7 billion on it. It's probably one of the best. It's integrated into the shopping mall, the ballroom. It's got food courts, and it's more like an airport terminal, really. So we've got, I think I mentioned earlier, 170 odd trains already between London and Birmingham today. Hence that, well, we've got that commute that is up and running now. And again, there's other areas I haven't talked about. There's Smithfield Markets. That's the old wholesale fruit and veg market. It's a £1.5 billion scheme. There'll be more shopping, more public realm, outdoor space, galleries, museums. There'll be a London Eye. I'm sure we'll call it a Birmingham Eye. So if you come and see for yourself, it's phenomenal what's happened in the city. So there's a lot that's going on at the moment. There's a lot that's happened, but there's a lot more to come, which is what we want to see as investors. It's, as I say, it's number one in Birmingham comes out number one in Europe actually for choice of where to invest. HS2, the trams, Smithfield Market, the regeneration in the city centre, Arena Central, Paradise Circus, Smithfield, Snow Hill Wharf. It's all part of a massive regeneration programme called the Big City Plan, which is a £16 billion project. It's a strategic plan for central Birmingham to create sort of fair and inclusive and green spaces for the benefit of the community. It's a sort of statutory planning framework that guides decisions on all regeneration in the city centre. It was from sort of 2016 to 2030. They've extended it now to 2040. So it guides all the developments and services and infrastructure in the city. So really advanced city centre planning. I've only really tried to hit on the big factors and hopefully get across what's happening in Birmingham because it is incredible. If anyone, maybe not tonight, but if anyone's got a quiet night, there's a fantastic 28-minute video from the council which explains in quite detail this plan, because it creates all these different areas with green spaces. It connects with the trams, it connects to areas outside of the city, so people living outside the city can benefit on what's going on in the city centre. As I say, I've just touched upon the tip of the iceberg really in terms of all the regeneration that's going on, but it is phenomenal. So for me, for our investors and for developers and build to rent schemes coming to the city, it's the perfect time to invest. I'm going to hand you back over to Liam, who's going to talk about our Birmingham investment, which we are releasing today. You're some of the first guys to see it. Thank you, Liam.
Thanks, Andrew. Okay, yeah, so this has been the first opportunity to introduce this new development to the global market. This is currently off market, so you won't see this development advertised anywhere, not on Knight Frank's website, not on Joseph Mews' website yet. So you are the first to sort of hear about it. So if we just go to that first slide, please. Okay, so the development is called SETL, and it is located in Birmingham's iconic Jewellery Quarter, which is by far the most popular location for that young tenant demographic. It's very, very close to all of those businesses that have moved into Birmingham from London that Andrew has referred to. And it's a very established part of the city. So yes, Birmingham is going through vast regeneration. So some parts of the city aren't quite there yet in terms of their attraction. Whereas the Jewellery Quarter, it has a lot of critical mass. There's lovely bars and restaurants. It's got that commercial offering, the retail offering, and it's just a very, very convenient location for all of those young professionals that work in the city. So if we just go to the next slide. Okay, so there's a sort of an aerial view of the development. You can see in the distance there that you can see a church spire. So 200 meters away from this particular development is St. Paul's Square, which is the sort of the prominent part of the Jewellery Quarter. It's the heart of the little residential location, and it is surrounded by lovely bars, restaurants, independent coffee shops, and it's a very, very cool place for sort of young people to socialise of an evening and a weekend. In the opposite direction, you're literally 200 meters away from Colmore Business District, which is where HSBC, Goldman Sachs, PwC, all of the big employers are located. This development as well, if you're going to go onto Google Maps to research the development, the easiest way of finding this is that it's literally at the foot of the BT Tower, which is probably Birmingham's most iconic skyscraper. So take a little look online, do your own sort of due diligence on the location, but you will not find a better located development in Birmingham. Not now, not in 10 years. This is definitely the most premier. I've been selling Birmingham for a good 10, 15 years now, and I am very, very excited about this particular location. So the nitty gritty, there's 1 and 2 bedroom apartments. There's 102 apartments in the development. There is a 6-story section and a 12-story section. You can buy here with a 20% deposit, just like the Derby development, and prices here start from 245,000. It is off plan, but this is well under construction. The roof is on, windows are going in, they're up to the 7th floor, and they're first fixing all of the apartments up until the 3rd floor now. So bathrooms, kitchens, electrics are all going in, and completion of this development is projected for middle of next year, so end of Q3 2024, which again gives you the opportunity to take advantage of hopefully those better interest rates in the middle of next year. So if we just go to the next slide. Okay, so you've got some images of what you could expect internally at SETL. The development is obviously again designed for that young professional market. The specification is very, very high. All of the integrated appliances are Bosch, for example. You've got designer tiling to the bathrooms and lots of extras such as fitted wardrobes as standard. So a lot of quality additions to the actual apartments themselves that you wouldn't get in a standard specification. On top of that, it's quite unique in a sense that although there's only 100 apartments or so, it has the amenities that you would kind of expect in a much larger development. So it has a co-working space, a residence lounge, it has a wellness studio, and it also has a rooftop podium. So on the 6th floor, it has a rooftop terrace, rooftop garden, where residents will be able to socialise in the summer, I suppose. It has got amazing views looking back into Birmingham's ever-changing city skyline. We go to the next slide. There's just some exterior photos. This is the location. So as you can see on this fairly basic map here, you can see where the development is located. The little icon of the BT Tower adjacent to that, right next to the Jewellery Quarter. It is literally 100 metres from St Paul Square and about 200 metres from Colmore Road Business District. As I said, look on Google Earth, you'll be able to see that. And like I say, if you're looking for a development to capture the investment opportunity in Birmingham, because Birmingham is definitely the #1 location in the UK for investment today and probably for the next 5 to 10 years, then this is a very unique opportunity. We won't be releasing this to the open market until probably Q1 next year. So this is going to remain off market, and we are looking to sell at least 50% of this development to investors. So you have a very small window of opportunity to be able to reserve here. Although this is the first time we've released the development to buyers, existing buyers of Knight Frank and Joseph Mews have already put in applications to reserve here already. So we do have pre-sales lined up. So if you are interested, please reach out to either Johnny or Andrew. And I think I'm going to pass over to Johnny now, and he's going to share an exclusive incentive offered just for people on this call this evening. Oh, sorry, let me just touch on this developer. So the developer themselves, the company that are building the development, it's good for you guys to know who you would be investing with, is a company called HBD. They've been in business now for 135 years and grown from a small family business to a large-scale real estate business. They work in all real estate sectors, commercial, residential, and also automotive. So they build some of the largest sheds along the motorways in the UK. So companies like Amazon are their tenants, and they do large-scale residential schemes as well. And they are currently working with a pipeline of £1.2 billion of development, making them one of the largest developers in the UK. Thank you.
Thank you very much, Liam, and thank you, Harley and Andrew, and thanks to all of you for staying on. I know it's we've been talking for a while now, but it's great to see everybody sticking around, and hopefully, yeah, to hear about the special offering which I mentioned at the beginning. The developer Henry Boot, who Liam just touched upon, they've agreed with Knight Frank to offer anybody that's been on this webinar tonight that reserves within the next 24 hours are going to have £1,000 incentive towards either their solicitor fees or to a furniture pack. So it's a nice little offering to have exclusively for those of you that have stuck around and listened to us for what, nearly an hour and a half now. So we're going to send this round, and we're going to come on to questions now, but a lot of them have been asking about, can I have details for Knight Frank mortgages to speak to Harley and understand the offerings there. We're going to contact you straight away after this with all of our details, and so Harley's will be on there. So anything you need, you'll have the contact details, and obviously feel free to ask anything else. Just to reiterate finally what Liam's just said, similarly, Andrew and myself have been selling Birmingham for nearly 10 years, and this site is one that we're incredibly excited about. Location-wise, it's really unbeatable, it being its vicinity to the CBD, but also to St Paul Square, which is probably the most sought-after address in Birmingham. You've got a huge developer in Henry Boot, trusted, reliable, good quality. You've got Knight Frank, and you've got these amazing amenities which are in demand in city centres of Birmingham, places like Birmingham now. So we're super excited about it, and if you'd like any more information, then don't hesitate to ask. So lastly, I'm just, again, conscious of time, just going to answer a couple of these questions, and I think if Harley can come back on, because a couple of them are around mortgages. one of them that we've got here is, doesn't say a name, Samir. Regarding mortgages, do foreigners qualify for mortgages? And if so, what criteria do I need to meet? Now, before I pass over to Harley to answer this, I'm based overseas, predominantly in Dubai, but we have an office in South Africa, in Durban as well. All of my clients are based overseas, and 95% of those clients take mortgages. So it's really important to understand that you do have options. It's a huge misconception that you can't get a mortgage unless you have a British passport or your bank account in the UK or some sort of footprint there. But as Harley will answer now, you know, that really isn't the case. So over to you, Harley.
Thanks, Johnny. And yes, so it seems that you've been educated yourself there. I would say that we predominantly work with international clients or clients with foreign national links, whether it be income that's derived in non-sterling denominated, or it's clients which are expats living in a different jurisdiction, or primarily just foreign nationals. The short answer is that yes, we definitely can help foreign nationals and international clients obtain mortgages for UK properties. What are the conditions and what are the requirements? Typically, there is a minimum income requirement, and that can be from personal employed income, self-employed income, or it can be from property or even investment income. The level of that requirement is different from lender to lender, and it's important for you to understand that we have access at the moment for over around 30 to 40 different international lenders that will all lend to different clients in different jurisdictions and to different client profiles. It's very, very rare that we ever come across a client, even from a high-risk jurisdiction, that we don't have a solution for. It's just about understanding your circumstances as a client, and also, of course, what your needs are. So we can then use our expertise and knowledge to establish what lender offers the most suitable lending solution and why that is. So I just encourage you to share your details at the end of the call, and then we can probably talk on a more personable basis about what the options would be for you.
Thanks, Harley. Yeah, absolutely. I think it's good to sit with Harley and just have a quick chat over the phone, and he'll be able to give you your options and make them relative to your own circumstances. We've had a few questions, as I say, about details for Harley and for Knight Frank. We've got one asking for Knight Frank's market report, which again we'll send around as well. We've got one question, somebody asking about rental management, and I touched on it earlier, but we do help with all of that. So as Andrew said, and as I touched upon, wherever we build, so in these cases, Birmingham and Derby, we have agents on the ground there that we deal with, both from long-term lets, short-term lets. So we will hold your hand through that, and we'll introduce you to the partners that we've worked with for many years. We've built a lot in Birmingham and been distribution partners for many developers in the city. So we know who's good, who's not, and we make those introductions. Again, another question about UK bank accounts. As we said, we don't need that. Well, you might need a bank account, but as when you speak to Harley when starting a mortgage, that will be something that is part of the process, right, Harley? That starting the bank account is a kind of necessary criteria.
That's correct. It is super important that you do have a UK bank account. However, we have a few different options where we can help you facilitate that. We can either introduce you to a bank which will set you up a bank account as part of the lending process, but we also do have access to subsidiaries of large international retail banks who will open up bank accounts for clients in many jurisdictions. So as before, we typically always have a solution, but it's important that you reach out very early in the process in order to open up the bank account, because that is one of the first and most important things for you to do, and we can't actually apply for the mortgage until you have that bank account open.
Perfect. Thanks again, Harley. Just been told that you've all got a handout in the chat box, I believe, a PDF that you can download, and we're going to send that round to everybody's emails as well. So conscious of time, as I say, we're coming up to an hour and a half. So I just want to thank everybody for coming on. Thank you again to Liam and Harley from Knight Frank, and to Andrew. And any other questions, if you'd like to book in a slot with any of us, then do let us know, and you'll receive an email shortly. So thank you all.